Rosie, do you want to kick us off by sharing your screen with the your favorite photo from Friday?
Do you know that I have a favorite photo from Friday?
You probably do.
Yeah, let me pull one up really quickly.
Good morning, everyone, by the way.
Mark, for a second there, I was like, I'd sent a photo to Jason this morning of like a photo of him and I from the pie tea, and I was like, did I accidentally send that to you? Because not again.
There could be worse things to send to people.
That's true. This is my favorite photo. I mean, does it get any better than Mark and Buddy the Elf with sunglasses on? I don't think so. Thanks to everyone who came out on Friday. That was such a blast. It was really good to see everyone in person. And I don't know if you guys have dug into your pie yet, but whew, holy crap, pots and pans really, they know what they're doing. So thanks for coming. Hope to see you guys all at Winter Lights this Thursday. We'll get those photos we had taken at the pie tea out to everyone later today.
Thanks, Rosie. That is the one I thought you would pick. I'm serious. Of all the ones I looked through, all of them, that is the one. I almost predicted it.
It's such
morning,
a
everybody.
classic photo.
Thanks for joining us this morning. We're going to dive in, and today is going to be rapid fire, basically 4 different things to tackle today. So just a quick reminder in terms of where we've been, and then I'm going to get a little discussion question to start us off. So we've talked about why this content, particularly for realtors, that financial literacy just in general is lacking, even for people that have had a lot of education, and that particularly impacts small business owners, to the positive or negative, depending on how much you rethink money. If you aren't tired yet of hearing me talk about shifting your mindset of money from 30-day periods of time to lifetime views of money, and how all the ways that our culture and economy kind of conditions us to think about money in 30-day periods of time as a function of income and expenses, rather than money over a lifetime as something that is a vehicle and an asset that it helps us accumulate wealth. That's something we're going to hit a few more times from different angles today. But again, if there is a running theme through what I would love to see happen, is that your thinking is challenged to push you away from what we're conditioned to think about money in terms of monthly periods of time, towards money as an asset that is accumulated to be used as a resource over a lifetime. We're going to hit 4 different things today, and they're going to feel a little bit disjointed from each other. But essentially what today is so if first session is about philosophy and why does this matter. Second session is about the profit loss and the balance sheet and how they relate to each other, how they're different from each other, and why that matters. This session is, here are the best examples that I can give you of what thinking like a small business owner looks like in your business. Okay, so if it's philosophy in session 1, kind of the nuts and bolts, a little bit more academic in terms of profit loss, balance sheet in session 2, this is, here are 4 examples of where the rubber hits the road. What does thinking like a small business owner look like, rather than thinking like someone who has a job? Okay, good. Sure, you're all tracking. Discussion question to start. You can dive into the chat if somebody's brave enough to unmute themselves. The opening question is, are you investing in real estate and why? Are you investing in real estate and why? So I'm okay just rapid fire reading off some of the responses that come in via chat. So, and by the way, a lot of people are going to say yes, but a lot of you are not yet investing in real estate, and that's fine. So this isn't nobody's going to look at you saying no and think, "Are you kidding me? They're not investing in real estate." Um, I love that I'm seeing a couple of you already say not yet. That's good. um, so for those of you that are saying yes, I would love to hear a why behind that investment. Yep, it's a good long-term play. Not yet. Yes, yes, not yet. Yes, passive income and long-term freedom. Cool, not yet. It's the area of investments I just know the most about. Good call, Tatum. Yeah, Natalie says it's my expertise in livelihood. She has a competitive advantage there. Absolutely. Leslie says, sort of. I love that. If you have a carriage house that you rent, I think that is a yes. Leslie, I see why you would say sort of, but good. Yeah, Steve kind of raises an interesting point there. Steve says, how am I going to tell my clients they should buy real estate if I'm not doing it myself? Yeah, Spencer referencing the same sort of thing. Spencer saying yes. So he's referencing the familiarity piece, that he has some expertise or advantage there. And then also that second thing, the passive income and financial security. That's good. Phil's saying future passive income. Good. Anybody who is not yet investing in real estate, why? Why are you not yet investing in real estate? By the way, I know that there's an obvious answer that I'm kind of looking for somebody to say, but I want somebody to say it. Why are you not yet investing in real estate?
Don't have the money saved for that.
Good. Yep. Cash, personal finances, money. Good. Is there another reason that is influencing some or all of you that are not yet investing in real estate? So obviously having access to the capital, that is the hurdle to investing in real estate. Thank you, Steph. Steph, can you share more of what you mean by that? Steph said ethics.
Yeah, I think, it's different for everyone, right? But I really want to make sure when I do it, it's very intentional for me and that I'm doing it to also to create, a financial future for my family, but that I'm not harming a neighborhood and I also have to be cognizant of my whiteness in that and being a white person coming in as a landlord. There's just a lot of factors at play that I've been thinking a lot about, but haven't done for financial reasons really, but that's going to be very important.
Yeah. Yeah, that's really good. I'll say comfort level is a broad category for what a few of you are getting at there. So obviously access to capital. Comfort level also matters. Even if you had all the capital you needed, comfort level in terms of how does this sit with my view of the world and the city and what's ethical and what's morally responsible? How does this sit with my risk tolerance? I might have the money, but how risky is this? Trisha and Steve both referenced timing, market timing. I think that's true for a lot of people right now, that they're sitting on the sidelines a little bit because, right, year over year, we just saw a 15% increase in prices. I just talked to someone literally this morning who sold a house. They just went pending on selling a house. They're not working with a plat agent, womp womp, but sold a house just now for $178,000 that they paid $148,000 for in February. They paid $148,000, did not improve the house, just sold it for 178. Like, and he called me to ask, like, what he was shocked. So he was basically asking, like, what happened? So that feeds into that question of timing that can be a hurdle to investment. Okay. So Steve is referencing the hesitation about the work involved in rentals. That's good. It can eat up your time. I'm a little worried that you said yet, Steve, that Steve has not gotten a fleas yet, that like that's an expectation of yours at some point in being a landlord. We might need to talk about that on a side conversation. But I'm glad that you haven't had them yet. Okay, thanks for that. We're gonna come back to oh yeah. Rosie, I forgot about that.
Mark, I just said earlier in the chat that rentals are also like a lot of work, and I got
Yes.
fleas from one of my rentals
Yes.
last year. It was terrible.
Yeah, I didn't catch that Steve was referencing the specifics. Yeah, thanks for sharing the horror story, Rosie. Okay, so we're going to circle back to investing in real estate. I kind of wanted to illustrate there that, like, look, here you have a group of real estate professionals who are just going to be at different places. So I don't want there to be this perception that, like, oh wow, everybody else on the call has all their stuff together and has their long-term financial strategy put together, and they're creating these passive income investments. Like, no, there's a really wide spectrum, and where you are right now doesn't really matter because you can't do anything to change your immediate financial portfolio, real estate portfolio. Like, nothing you could do right now changes that by the end of the day. I think an honest evaluation of where are you right now and where do you want to be in the future is what you can do right now. Change the trajectory. So kind of recognizing you're in good company wherever you are. Zero real estate investments, a lot of real estate investments. Let that go and say, where do I want to be and how can I get there? So we're going to circle back to the real estate ownership piece. Okay, second question to dive into our first bullet point for today. The first bullet point is the investment rather than expense. If you're working off of the outline that I sent from the first session, that is a bullet point on there. I'm not going to go in order of those today, but so investment rather than expense. Would you describe yourself as someone who likes to spend money? Yes or no? You can nod yes or no. You can thumbs up, thumbs down. You can jump into the chat. Are you someone who likes spending money? Joel, that means yes. If you're saying yes and no, you like spending money. I think this is about a 50-50 would be my guess, that in most groups, about half of us like spending money and half of us don't. Yeah, Steve, that's also a yes. If you like spending money until you run out of it, that just means you like spending money. Yeah, Steph, that's a no. If you only like spending other people's money, then you don't like spending money. That I should have clarified. You're right. That just should have given a more specific question. Do you like spending money when it is yours? Is really what I meant. Lance does not enjoy it, but appears to be a professional at it. Lance is a pro at spending money. Yeah, Joel, I knew that already, actually. I knew that you like to spend. This might be oversimplifying. I do think most of us tend to one direction or the other, that our default is to spend money, and then we have to kind of work against that default to not spend it, or our default is to not spend, and we have to work against that in order to spend. And we talked about this a little bit in the first session, that likely comes from your family of origin, right? Like from whatever environment you grew up in, not necessarily that you behave like the adults that you observed. A lot of us might be intentionally behaving exactly the opposite of what we observed as a child, right? So it doesn't mean that you inherited the behavior, but it just means the behavior you observed from adults when you were growing up, that somehow has formed, positive or negative, your view of spending money. You also, I think this is really interesting. We all have moral and ethical implications and ties to spending or saving. Like if we could really dive into this, my guess is that about half of you on the call view saving money to be morally or ethically preferable to spending. And then probably about half of you have a conscious or subconscious moral or ethical preference towards spending or investing. So we won't dive into where that comes from, but I think we all just, I want to acknowledge that the money going out the door, we all have tendencies. I think the important question is, how hard are you thinking about those tendencies? And I've been around realtors now professionally for, I guess, coming up on 13 years. I'm about to start my 13th year. Okay. And an observation that I have made, so I've been around a couple different small business industries. I'm a little bit more recently, I've been around the food and beverage industry. Most of y'all know my family's been around the car business for a long, long time. I'm around real estate developers, investors. I get to interact with a lot of small business owners in different industries around downtown Indianapolis. And one thing that strikes me about realtors, and I want to know if y'all agree with me on this, I believe that realtors spend notably less on our business than similarly sized small businesses. Okay, I'm going to say that again. I believe that realtors spend notably less on our business than other small business owners of similar size and revenue. You're welcome to disagree, 100%. But I think this is actually kind of hard to disagree with, because I think it's a fairly obvious point that we spend less. What I want to know is why. So whether or not that's you could be the biggest spender as a realtor. But why would realtors spend less money, have less expense as a business than other similarly sized small businesses? And there's tons of reasons, some of them wise, some of them unwise. So this isn't a better or worse, but why would we spend less? Steve, clarify there. Steve says lower overhead. Steve, do you mean because our business just has lower overhead, or because people want lower overhead? So is that just a reality, or is that a preference?
Okay,
Yeah.
so what I mean by that, I was going to type this out, but I'm not going to do that. I mean, I don't have right now. I mean, you can choose to add employees, things like that, but I don't have employees. I don't have to buy a building to put my business in, all that kind of stuff. Now, those are things that I can change, but I have the option to do that. I'm, you know,
And no materials.
yeah, no materials.
Yeah. Yeah. And a couple of you hit on this. Steve summarized it nicely there, just in terms of overhead spending. So I think partially this is because we don't have to. So one reason that realtors would spend less money is because as a business model, we aren't buying inventory. We don't have to buy product to convert it somehow, like a restaurant. Restaurant cannot possibly function without spending money, right? They have to lease or buy a space. They have to hire some form of employee. They have to buy raw materials that they convert into food that they're going to sell, right? So as realtors, we do have the luxury of deciding on our overhead spend. That's a part of the reason why. And then the second is just this question of like, well, okay, I know I don't have to, but if I could, should I? So Jenny references the future is uncertain. So I think what Jenny means there is, why would I spend money to try to generate something in the future that I'm not certain is going to happen, right? Logical question. Joel says value on face-to-face, like maybe I think what he means there is, why would I spend money that I don't have to if I can create value without spending the money in the context of relationship, face-to-face? So there's, I think, necessity reasons and then kind of philosophical reasons. Well, I'm going to encourage you to rethink a bit spending money. This is where the investment rather than expense mindset comes into play. And what I don't want you to hear me saying is you should be spending more money in your business. That is not a catch-all statement. Some of you should be spending more money in your business. That is a safe. I'm certain that at least someone on this call is probably underspending, but that's not my point to communicate to all of you. I think as a business owner, there's this crucial shift from using the word expense in your mindset to using the word investment in your mindset. An expense, by nature, has a negative connotation. An expense is something that in any way that you could, you would minimize an expense. Fair? Like you try to increase profitability by eliminating expenses in any way that you can. Okay, so that's why it's a negative. An expense just reduces the amount of money that you make. An investment is something very different. Y'all know the difference between the words. But when you spend money as a business owner, you should always view it as an investment. And that's not just to make you feel better about spending the money. It's because I think it correctly orients your mind to whether the money should be spent and what you do as you're spending it. Now, some spends are less flexible than others. For example, if you don't pay MIBOR your annual technology due, okay, it's going to be really hard to do your work, right? So there's just some stuff that you don't have a whole lot of flexibility in, and whatever your mindset is, you're just going to have to pay it. But those are kind of the exception. Most of the time, I think you really are in control of the spend. And y'all see that this expense versus investment difference, try to catch this. This is a really good illustration of the 30-day kind of cash flow mindset to money. Views spending money as an expense. The wealth generation, long-term lifetime perspective of money views spending money as an investment. It may not be a good investment. There are good investments and bad investments. but a lifetime net worth perspective of money. Let's say anytime money goes out the door, it's an investment. The question is it a positive or negative return in the future? So when you spend money, is your first thought, how does this impact my annual bottom line? Or is your first thought, how is this going to return to me in the future, positive or negative? Right? So someone that has a job, if the mindset is I have a job, I'm thinking about income and expenses. Someone that owns a business, yeah, they're thinking about income and expenses because they have to create a profit loss, but they're going to be more oriented to their balance sheet and their personal financial statement, therefore viewing money going out the door as an investment rather than an expense. I'm going to give you 5 examples of what this could look like in your business, but it's not so much about the 5 examples as much as it is thinking about, I'm a small business owner who will make financial investments in my business. You can't avoid it. You will spend money. So then the question is, how much money am I spending? And where am I directing those investments? Seeking to have them pay off in the future. So Steve referenced this earlier. Example number 1 is hiring help. Transaction help, marketing help, administrative help, buyer's agent, building a team. Like, so there's all this kind of big category of investing in human resource, right? This is small businesses around the country. This is the largest area of investment for small businesses in just about any industry is people. So when and how do you do that as a realtor? That's an investment. Number 2, marketing and advertising. A lot of you don't spend money on marketing and advertising. I'm not suggesting that you should, but make sure when you're making that decision, you're thinking about it as an investment, not as an expense. Number 3, client care. Thank you gifts, client entertainment, client events. Again, you could look at this as an expense, or you could try to think about this as an investment that has an ROI. Sponsorship. This is something that's pretty popular here in the kind of Platte community, which I think has a really good ROI. It's hard to measure. But again, thinking about community sponsorship of organizations and events as something with investment potential. Coaching. A couple Platte agents do invest in professional coaching. I think it's something that a lot of agents, if you're focused on money going out the door as an expense, it's going to be pretty difficult to justify something like a professional coach. If you're focused on the lifetime return of money as an investment, oftentimes professional coaches probably are the best money that you will spend. So just 5 categories as an example. So thinking about yourself as a business owner, I'm trying to beat that into your head. Business owners make investment decisions. They don't make spending decisions. So just try to even remove the words spending and expense from your vocabulary as a business owner. Insert the words leverage or invest. So I think then you're more likely to be correctly thinking about that money that's going out the door. Angelica, I don't think you're the only one who feels like you already spend a good amount of money. I think sometimes it disappears pretty quickly, but I think a lot of realtors feel like they spend a lot of money. My point about the industry comparison is to say other industries that have similar revenue models to ours would look at your profit loss and say, wow, the expense structure in this industry is really low. relative to what we might be used to, it can feel high. But I think other industries, it's just something to think about in terms of mindset shift, not to get too stuck into how realtors think about their business when there are probably more broad small business principles that would would help you to value that spend. Okay, I'm going to transition, and I'm not going to give time to questions yet on the investment rather than expense. But if you have a question there, kind of note it, and we'll come back to it at the end. Second is tax strategy. Y'all, if you have something you could grab a piece of paper and a pen to write a few things down, or pull up a Word or Google Doc or something that you can type out on, because I think some of you are really going to want to jot a few of these things down. In the whole 4 sessions that we do, this might be the most pragmatic point that I make. It's tax strategy. Okay, so the problem here, realtors can make a bunch of money. And because they don't think about themselves as small business owners, they're not as likely as other small business owners to develop a coherent tax strategy. That's the problem. Okay, that's the one I'm trying to speak into. Tax strategy advice number 1. Make sure you have a lot of cash on hand in April. I mean, this might be an obvious statement, but guys, I'm telling you, residential and commercial real estate brokers, I know one. I personally know one that essentially lost 2 years of their business because they had a really good year and didn't plan accordingly and just didn't have money in April, like a lot of money in April to pay their tax bill. And it buried them for 2 years. So worst case scenario, if your tax strategy is just making sure you have cash on hand in April on the year that your business makes a big jump, okay, then we've at least accomplished something. So I'm going to get a lot more nuanced, but that's number 1 is on the year that you make a big leap, make sure you have cash on hand in April. Now, a couple of you referenced this last week, that your CPAs are pushing you to make quarterly estimate payments. That's something for those of you that are newer in the business. When you start to generate more revenue, there's going to come a year where you make 6 figures and your CPA is going to say, hey, I don't think it's a good idea for you to wait until next April to pay your tax bill. You probably need to start making quarterly estimates. What that means is at the end of every quarter, you're going to send an estimate payment to the IRS based on what you made last year or the last 2 or 3 years, partially just as a way to manage cash flow to ensure that you're not going to have this giant bill in April. But also partially because the IRS may eventually give you a hard time. So if you're continually making a bunch of money and you never pay any taxes until April 15th, that can be like kind of a flashing yellow light to the IRS. So there's nuance to that. It all depends on what your return looks like, but that's what quarterly estimate payments are. So that money doesn't just like disappear. It's making an estimation of what you think you're going to make for the year, making 4 tax payments throughout the year instead of 1. And if you happen to overpay, you get a refund. So it's a cash flow tool that can be helpful, and your CPA is probably eventually going to advise you to do that if you're in the business for long enough. Okay. Now to the real meat of tax strategy. I'm going to make a philosophical statement here. This was Rich Dad, Poor Dad, talked quite a bit about taxes. I believe that it is the responsibility of any business owner to wisely and legally seek to reduce their tax liability. I'm going to say that again. I believe it is the responsibility of any business owner to wisely and legally seek to reduce their tax liability. This has been a little bit, I don't know if I want to say it's been politicized, but it's certainly been in politics of late. I immediately knew that Steph knew what I was going to say. Steph's right in the middle of my screen right now, and she was like smiling and laughing. Anybody want to go ahead and state the obvious? What do I mean? This has been politicized in the llast few months, or just at least in that realm, Steph?
Our president has only spent $750 on federal taxes, and there is tax. He's paid forward a lot of taxes and also offset a lot of expenses due to profit losses in his business, but according to laws that he passed in 2018. That's it.
So perhaps we could say it's alarming to a lot of us that a billionaire has paid less income tax in the last decade than the majority of us have, right? There are areas of that conversation that we could dive into. I just want to acknowledge it and say, look, I think this is a little bit of a heated topic, but I stand by my statement that I think it is the responsibility of a business owner to wisely and legally, therefore honestly, seek to reduce their tax liability. I think there's limits to that. There's tension to that. I want to make the point that whatever you choose to do with the money, I think there's some really great outcomes that you can do. One of the ways to reduce tax liability is to be generous, right? To find ways to reinvest that money into your local community. That is a part of a really good tax strategy. So this doesn't all necessarily have to be self-interested. I'm not trying to advocate for how I think our tax laws should be written. That is a much different conversation. I'm just talking here about how they are written. Okay, so my guess is that none of us on the call have much influence in how our tax code is written. You're just a business owner that's going to try to learn how to respond to how the tax code is written, okay? And I think it's a part of your responsibility to at least think about legally reducing your tax liability. Okay. I'm going to give you a couple categories of how to be thinking about tax strategy, but one more one more little plug here about the revisiting the income versus net worth. Jot this down. Think about the fact that your annual tax return can legally show a number that is noticeably lower than the increase to your net worth in that same year. So I'm going to give you a couple numbers here, but just think, embrace that this is a real possibility. That you could have a year where your tax return legally shows that you made $50,000. You're paying taxes on $50,000 of income. But yet in that same calendar year, your net worth started at $100,000 and ended at $175,000. I'm going to let that sit for a second. In that scenario, how much money did you make that year? So I'm going to offer an answer. Your tax return says 50. Your net worth went from 100 to 175. How much money did you make that year? Good. I have 3 different answers. Andrew or Jenny, tax return says 50, net worth went up by 75. Jenny, why are you saying 175? Or Andrew, why are you saying 125?
Maybe I misheard you. I heard that you said that they went up to 175.
Yeah, so your net worth started the year at 100. On January 1st, your net worth as an individual was $100,000. On December 31st, your net worth was 175.
Oh, okay.
Here's what's so interesting about the what did you make last year? There's actually 3 different ways to answer that question. Number one, which is probably the most common, what does your tax return show? Right? Y'all, plenty of 100 millionaires and billionaires regularly have tax returns that show they made no money. If you didn't know that, perhaps the news cycle of the last 60 days have proven that to you. It's true. It's not just Donald Trump. So that is one way to think about what you made, but tax return is one. 2 is what did your net worth do? I was worth $100,000 at the start of the year. I'm worth $175,000 now. I think that's the best way to think about what you made. The third is in that scenario, what about living expenses? That person actually probably made $150,000. Y'all see that? Because in order to have increased their net worth by $75,000, well, they had to spend money to live, right? They bought food, they bought clothes, they had rent, they paid interest on a mortgage, they had living expenses. So you could also be thinking about like, how much revenue did I have in comparison to what I spent, and where did the gap between those two go? And a lot of you are thinking like, gosh, my head's spinning a little bit with these numbers, and that's okay. My point here is that as a small business owner, you have the luxury to think about income as gain in your net worth, not necessarily what shows up on your tax return. Yes, Jenny, that's a very good transition question. Why isn't the number on your 1099? Because your 1099 is revenue, which is different than income. Your 1099 is the top line number that shows up on your profit loss. So then here's the question, what do I do with that money? And are there vehicles to legally reduce my tax liability? Okay. I'm just going to give you 2 categories here. So if you're still jotting down, category number 1 is going to be a couple specific pieces of tax advice that are not related to owning real estate. So that's category 1, non-real estate ownership related tax advice. Category number 2 is going to be connected to owning real estate. Okay. Number 1 in the non-owning real estate category, Indiana 529. College education savings plan, Indiana, it's a fantastic deal. I don't know why it's not more broadly known, or maybe it is more broadly known and I just don't realize it. But the state of Indiana will offer a 20% income tax credit up to a $5,000 contribution towards a qualified advanced education savings program. Okay. You do not have to have children to do this. This could be a wealth generation strategy, and the day could come because you can gift the fund to anyone that you want, or you could use it yourself for advanced education. So what that means is at the end of a year, if you've had a particularly good year, you can contribute $5,000 to what's called an Indiana 529. And if you Google Indiana 529, it's very easy to get information on this. Steph, yes, I'll come back to that in a moment. Contributing $5,000 will immediately reduce your income, your tax income liability to the state of Indiana by $1,000. So that means you have $5,000 show up and it costs you $4,000. Okay. yes, it has to be used on income in order to utilize that tax gain. But your worst case scenario in a 529 is that you never use it for income or for higher education, or your children never use it for that, or you never gift it to someone to use it for that. You later withdraw it and pay the income tax at that point in time. So there's really very little downside to this. And so a 529, Jahan is right. We're not necessarily talking about universities. There are actually a pretty broad range of, and it grows over time. Like there are more and more options about how to use a 529. That would be something I would be looking into, particularly if it's like that first year or two that you have where income went up and you're kind of sitting at the end of the year with a bit more money than you were projecting. A 529 can be a really good vehicle for that. Number 2, in the non-real estate ownership category, what expenses for my next year can I incur late in this year? So if you didn't know this, the IRS will allows you to legally incur expenses in November or December of a given calendar year that are really truly oriented to next year's business. This could be you might be doing a big client appreciation event in April. And you know that you're going to, I'm just throwing out a hypothetical here, but you know you're going to spend $5,000. Well, it might be to your advantage to pay that on December 27th. Because what that does, so this is a small business owner luxury, is that is going to be a deductible expense. And if you can pay it in December, that reduces your tax liability for the year 2020. Now, you might be thinking to yourself, well, wait a minute, didn't I just increase my tax liability for 2021 by doing that, right? I pulled an expense out of 2021 and put it into 2020. Yes, you did. But this is small business owners all over the world are doing this right now because it's the month of December. If you can defer taxes by a year, the true cost, the time value of money, is that those taxes cost you less money. So here's a legal vehicle as a small business owner that you have by pulling expenses into a current year that are probably more truly oriented to the future year, can reduce your tax liability, therefore pushing taxes off into the future. Generally good practice. Okay. Okay, number 3, last one in the non-real estate ownership category. Are you writing off everything you can? I think this is it's like a achievement badge, I suppose, in real estate. Is at what point do you make, air quote, enough money to start really truly tracking expenses and ensuring that you're writing everything off that you can, right? Because hey, if in your first year you made $15,000 by doing a couple deals on the side, right, there's probably not a whole lot of upside for you. But here's the thing, if you were going to think about yourself as a business owner who's going to grow revenue, the earlier the better, to start to ensure that you are tracking and deducting every expense that you can. Some of these are fairly obvious, right? Your brokerage dues, your MIBOR fees, your cost to buy your continuing education. Some of them are a little bit less obvious. And I don't want to play like I'm a tax accountant. Like a good CPA is going to be better at advising you on this. My advice is that a responsible business owner needs to be convinced that they're legally deducting everything that they can. So that's a conversation with the CPA, but a couple examples, mileage on your car and or gas. You can't deduct mileage on your car and gas, but one of the two is likely something that you should be deducting. Client meals. The IRS has changed the percentage of food that you're able to deduct, but you still can claim a 50% deduction. So that means if you take a client out to dinner and spend $100, you're legally allowed to declare 50 of that 100 as a business expense. Thank you gifts, housewarming gifts. Thank you, Zach. Home office write-off, right? I think realtors, if they're paying office rent, they're more likely to deduct that. Sometimes they don't realize they can claim expense on their personal residence. They use a prorated amount of their personal residence. So there's other examples there. I just think about tax strategy as a business owner means ensure that you're deducting everything that you can legally deduct. It doesn't, by the way, mean spend money only to get the deduction. When you spend money only to get a deduction, it's probably at best like a 30% discount on that money. So hopefully you're getting some other value in that. But it does mean make sure you are claiming every deduction that you can. And I think in general, realtors probably aren't great at doing that. They will work their tail off to get the next deal that pays them $6,000. And they will avoid tracking expenses and deducting correctly like the plague, even though it will likely save them more than $6,000. That's my observation of realtors in general, not speaking of any of you specifically. Okay, I'm shifting to the second category of tax strategy. And if y'all are still awake, I'm impressed because I know how thrilling tax strategy is. Some of you are jazzed by this and some of you are not. So I'm going to give you 4 things to think about in terms of owning real estate. I know you guys understand that owning real estate can be profitable. I'm not convinced that realtors have their minds and arms around how good of a tax vehicle owning real estate is. I think we think about appreciation. We think about speculation. We think about flipping. We think about rental cash flow. We probably know those things. We don't think about taxes. So, owning real estate has been the primary means to accumulate wealth for the history of the world. Whether you're aware of this or not, all 4 of those books that I recommended reference this. If there is a predictable means to accumulate wealth, it's owning real estate. That's the way that the world's economy has worked as far back as you want to trace it. Before money existed, it was land, right? Did you also know that in the United States, owning real estate is the most common means to legally reduce tax liability for the wealthy? It's not the only means, but it is by far the most common means. And guys, it's almost like the people that wrote our tax laws own a bunch of real estate. And again, I'm not trying to have a conversation about what should be true here. I'm just encouraging you to acknowledge that the laws were written by people that own real estate. And it's fairly obvious. When you start to learn about the tax advantages of owning real estate, it can be a little bit shocking, honestly, as to what owning real estate allows you to do in terms of taxes. Do I think that's fair or equitable? No, I don't. Do I think that means it's responsible not to pay attention to it? No. So I think there's 2 different conversations there. One is the should, one is the reality. And so I think at the very least, educate yourself on this. Whether you get to a point of using real estate to reduce tax liability or not, if you're informed on it, great. So that's my goal. Okay. 3 ways that real estate can help you reduce your tax liability. Number 1 is depreciation. So the IRS allows you to depreciate an asset that you own. And I know this is like heavy accounting terminology. If this doesn't make sense to you, text or call me later and I will explain it a different way. But just think about for a moment, if you own a $100,000 residential investment property, on average, what happens to that $100,000 investment property in a given year? Anybody tell me what's the national historic average for the value of a piece of residential real estate annually? What does it do? Spencer, did you just say 3? Yeah. Yeah. Natalie says 4% appreciation. Spencer says same. Yeah. It's between 3 and 4. The national average historically is that residential real estate is going to appreciate between 3 and 4% a year. It is increasing in value. That is money. That is value. It's net worth. It's wealth that you do not have to pay taxes on until you sell that real estate. We're going to come back to that. Not only do you not have to pay taxes on that 4%, the IRS says you can pretend that over the course of 27 years, that $100,000 piece of real estate depreciates to $0. Guys, it's insane that you're able to do this, but you are.
Can you say that again, Mark?
The IRS says that over a period of 27 years, it's called straight line depreciation, that in 27 years, at something like 3.5% a year, you are able to claim a loss. So on your taxes, you own a $100,000 piece of residential investment property. At the end of the year, that investment property on average is going to actually be worth $104,000. However, the IRS says, no, you can actually claim a loss on the improvements of that property depreciating by 3.5%, which means you get to write off $3,500 of depreciation as if it's an expense. You made $4,000 that you don't have to pay taxes on, and you can declare $3,500 of loss against other income. That's a tax savings for most of you of something like $1,000. Okay? You don't have to understand all the nuts and bolts of that. You will someday, you'll need to. But for right now, just understand that that's one of the 3 reasons that owning real estate can be a really powerful tax strategy, is that you get to declare that depreciation every single year, even though the property is actually increasing in value. Okay? Understanding depreciation as a business expense is an accounting principle that's going to be a little bit difficult to wrap your mind around. This might be something where I would say, look, 2 of your brokerage staff people have accounting degrees. Ashley and Gigi both have accounting degrees. They could probably take some time and explain this to you at some point in time. I don't have an accounting degree, but I like to pretend like I do. So I'd be happy to talk to you about this, but just know that this is one of the reasons that owning real estate is really powerful for taxes. Number 2, 1031 tax deferred exchange. How many of you have been a part of a transaction where you or your client did a 1031 exchange? A couple of you. This is what I kept calling 1099s earlier. Sorry about that. The premise of a 1031 deferral is that $100,000 piece of real estate, over the course of 27 years, you own that property for 27 years, you're declaring a $3,500 loss in depreciation on the property every year. After 27 years, what's called your basis in that property is actually down to 0. What's that property probably worth in 27 years? Oh, on average, it's probably worth $250,000. You bought it for $100,000. You got the tax advantage for 27 years, and now it's worth $250,000. If you were to go and sell that property for $250,000, this is where the kind of windfall tax event happens. Because your basis is now 0, you owe $250,000 in what's called capital gains. Okay, so you now have a capital because you sold an asset and you had a gain of $250,000 on that asset. Well, the advantage of the depreciation thing would be mitigated a lot if every time you sold real estate, you had to pay money on that gain. This is why the 1031 exists. The people that wrote the tax laws own real estate, and they realized the depreciation's nice, but if we just have to pay income on that money when we sell the real estate, the upside's limited. In a 1031 exchange, you can take the capital gain and put it into a deferred exchange, use it as a down payment to buy more real estate. And you don't pay taxes on it. You pass the gain into that new piece of real estate. So I'm going to give you another example here to make this more simple. You buy that rental property for $100,000. Don't worry about the depreciation. 3 years later, you sell that rental property for $150,000. Okay, you probably made some money on it during the 3 years, but we're going to focus on the $50,000 that you made in capital gains. If you don't do anything with that $50,000, you're likely going to have to pay about $10,000 in taxes on the 50. Okay. What a 1031 exchange allows you to do is take that $50,000, put it into a 1031 account, and within 6 months, spend that $50,000 to buy a replacement piece of real estate that is likely a much more expensive piece of real estate, and you don't pay any taxes on the gain. You get all the value, your net worth increased by all 50. You just moved it to another piece of real estate, likely a larger one. There's a section in Rich Dad, Poor Dad where he talks about doing this over and over again. I think his first transaction was like he made like $15,000 in capital gains, did a 1031, bought a bigger piece of real estate, sold that one 3 years later, did it again, did it again, did it again. And so much of that is possible because of the laws surrounding a 1031 tax deferred exchange. I think as realtors, this is an important thing for us to understand. If you ever want to do like a CE class that focuses on 1031s, pick my brain about them. I've done several. It's a really good vehicle, and owning real estate is a nice way to defer taxes in this way.
Mark, is this different if it's your residential property? Like, okay.
Yeah, so anyone want to answer that question? Y'all should probably know this. This is why when you're at a closing and the settlement agent says, was this your personal residence at least 2 of the last 5 years? If you're making money on your personal residence and you lived there for at least 2 of the last 5 years, there is an exemption on the capital gains income tax. There may or may not be some realtors who are also real estate investors who typically sell their personal residence about every 2.5 years. That's a part of why. Because there's a capital gains exemption up to a certain dollar amount. Yeah, Tricia, the reason an investor wouldn't do a 1031 exchange is they need the money. They need the liquidity. They have to have the cash. So if you're selling the piece of real estate because you need the money for something else, you can't do a 1031, because a 1031 only works if you pass that wealth into other real estate.
So, sorry, can I jump in here?
Yeah.
So, but if you're continuously buying and flipping, is there any really good reason to not? Or, I mean, you could always be taking a section of the money, couldn't you, and putting it into a 1031 from whatever sale?
That's right.
I haven't.
Yeah,
is it a different closing process for us or buying? Or I haven't done a 1031, and I've worked with a lot of investors, and I don't know why they're not doing this. So that's what I'm curious.
Well, there's a couple. They might not know of it. They might not want to deal with the complexity. There is a little bit of cost to doing a 1031. There's a First American title office out of Minnesota that's a qualified 1031 exchange office that works with First American here in Indy. One reason, Tricia, that those investors may not be doing it, and I'm happy to dive into this with anybody in a future like 1031 session, is if they're flipping houses,
Mm-hmm.
that's considered regular income, not capital gains. So a 1031 is not eligible. If you buy a house and renovate it and sell it in 6 months,
That's why then. Okay.
that's considered business ordinary income, not capital gains. So you made money by flipping that house, not by the asset appreciating in value over time.
Okay. Yep.
Okay. Third thing, owning investment real estate does for taxes. It gives you a new category of expenses to write off. So most investment real estate, by the time you write off interest expense, property taxes, insurance, maintenance, you're likely not having to pay taxes on most of the true long-term wealth gain that real estate is providing. And it also gives you a lot of flexibility on when you declare those expenses. So I know a lot of you are thinking like, this is starting to sound like stuff I'm not passionate about as a business owner. I just want to try to get things onto your brain to think like a business owner, and y'all are going to apply this in different ways. If you at least walk away thinking, okay, owning real estate's pretty good for taxes, I should probably understand that more. Fantastic. Always happy to talk more about it with you and or your clients. Okay, hitting pause. I've got one more topic to dive into, and then we're going to talk about what our goals are for the 4th session. Okay. Yes, you can, Diane. You can do a 1031 a second home, as long as you've owned it for long enough. Yeah. Okay. Final point for the day, debt. Coming back to this mentality of money every 30 days. If we're thinking about money in terms of 30-day periods of time, what's coming in, what's going out, debt is generally going to be something that you should avoid. You remember us picking on Dave Ramsey. This is kind of the Dave Ramsey principle is debt is bad, stay out of debt. Well, that philosophy fails to understand that there's 3 different types of debt. So you may want to write this down. Type number 1 is unsecured debt. Sometimes this is called consumer debt. If you have a bunch of credit card balances, you have student loans, you have medical bills that have turned into collections or debt, those are all unsecured. It's debt that isn't tied to a physical asset that you own. As much as people have tried to make the case that student debt is secured debt because it's tied to your mind, that's bullshit. Student debt is unsecured debt. May or may not be worth having. Different conversation. Type number 1 is unsecured debt. Type number 2, secured debt on non-cash producing assets. This is your car, and this is your mortgage on your personal residence. Type number 3, secured debt on a cash generating asset. We're primarily going to think about this as debt that you take out on investment property. There are other forms of secured cash flowing debt, but they're more complex and we're not experts in those arenas. Looking at debt as if debt is debt, it's just not true. Debt isn't debt isn't debt. The type of debt that you're talking about is makes radically different implications about how you should handle debt. So in general, if someone could avoid unsecured debt, should they? Yes. In a lot of cases, that's not realistic. But understanding the difference between unsecured debt secured non-cash flow producing debt and secured cash flow producing debt is critical. And I'm going to run through an example here. And if I haven't lost you yet, I know I'm going to lose you in the example, but do everything you can to write this down and engage with it. Because if I lose you by the end of this, I guarantee you got at least a little bit closer to understanding why debt matters in real estate. And if I lose you, you can later say, okay, you got to give me more resources on how to understand the how debt leverages real estate investment. So I'm going to give you 2 examples of what you're going to do when you inherit $100,000 from your uncle. You all just inherited $100,000. Congratulations. So there's 2, you're at a fork in the road, and there's 2 different ways that you can handle this $100,000, okay? In scenario number 1, you buy a $100,000 rental property in cash. That rental property is generating $1,200 per month in rental income. Keep writing this down. After accounting for your expenses, so I'm using a 10% property management fee, 10% vacancy factor, 2% real estate taxes, typical insurance, typical maintenance. That property projects to $6,664 of net income per year. So you took $100,000, bought a property in cash. After all your expenses, you're going to make $6,664 per year, which is a 6.7% cap rate. It's also a 6.7% ROI. Okay. You also get to depreciate $3,700 of that property, which is probably going to be about $1,000 tax savings. So that means your actual true profit on that property is $7,664. Okay. So that's the end of scenario 1. Scenario 2. You take your $100,000 that you inherited and you split it into 4 chunks of $25,000. You use each of those chunks of $25,000 as a 25% down payment to buy a $100,000 investment property. So you now purchase 4 investment properties for $100,000 using $75,000 mortgages on each one. Using all of the same assumptions, $1,200 in monthly income for each one, all the same expenses, etc. You have to add in interest that you're paying on all those $75,000 mortgages. I'm assuming right now you're going to be paying about 4%. On a typical investment loan right now, that's about what you're going to pay. That adds $12,000 of expenses, which means that each of those properties making $6,664 times 4 minus the incurred interest expense is going to be $14,656. Okay. You also now get to declare $14,800 in depreciation, 4 times the depreciation, which is going to net you $4,000 in income tax savings. So in scenario 1, you're making $7,664 per year off of your $100,000. Okay. In scenario 2, you're making $18,800 off of your $100,000. Okay, so more than double. This is why people call debt leverage. Okay, taking the same amount of money, same amount of total investment, using debt to leverage the return. And I haven't included the appreciation of those properties. One property is appreciating by $4,000 a year. 4 properties total are appreciating by $16,000 per year. By the time you add in appreciation, you're looking at scenario 1 as making $11,664 per year. Scenario 2 making $34,000 per year. So by utilizing debt, you tripled the amount of money that you're making. As a realtor, do you need to understand all the nuances of that? It helps, right? This helps you speak a language with your investor clients. But I look at realtors, it shocks me. Like, y'all, there are realtors that are in Indianapolis that are making $500,000 a year and they're not investing in real estate, and I don't understand it. It doesn't compute to me. They might have good reasons. I just don't understand them. And if they are investing in real estate, they're not utilizing debt because I don't think they understand how powerful of a tool it is in real estate investment. I'm going to ask the question though, because I think some of you are probably thinking, why would you not utilize debt? There's two reasons, two legit reasons why you would not utilize debt, or why you would at least limit your utilization of debt. Anybody want to take a stab at one of those? Yeah. Steph and Joel both just got it. The first one. Utilizing debt increases risk. If you lose your job and the market tanks and you got to start selling stuff, you own one property and $100,000 in cash, you're fine. You don't owe the bank any money, right? You're going to be okay. And yeah, in 2008, we learned that a lot of real estate owners were over leveraged. Now, most people that got over leveraged in 2008, just as an FYI, they did not borrow money against their purchase price. Y'all, what happened to most of those people is that 5 years after buying that $100,000 rental property, they got a bank to loan them $180,000 against the property, as if it was now worth $250,000. Well, it was never worth $250,000. Most of those people over leveraged by borrowing more money than a property was really worth. That gives debt a bad name. Okay. It doesn't mean there's no risk. I'm just saying that there is a higher perceived risk to utilizing debt because of the way in which sometimes people and banks use it irresponsibly. Yeah, Steph, most of them bought a car or went on vacation. So no. And look, there were people that didn't do that, that had really bad outcomes in real estate, but they're the exception. Okay, number 2, the other reason that you wouldn't utilize debt. Go back to those 2 scenarios. And if you were jotting down the kind of comparison between those 2, this is a surprise to people, particularly if you're of a 30-day mindset with money. One of those scenarios, you used your $100,000 to make $11,000 in profit a year. The other, you used your $100,000 to make $34,000 a year. Okay. In scenario 1, you're making $11,000 a year in terms of net worth, but you're actually getting a little over $6,000 of that in positive cash flow. Okay. So the majority of your profit in that scenario is showing up in your checking account. You see the money. In scenario 2, you're making $34,000 a year. Scenario 2 actually projects to a positive cash flow of $16 a year. Guys, this is why the mindset difference matters. A 30-day cash flow mindset would look at scenario number 1 and say, oh my gosh, that's awesome. I am making over $6,000 a year and I can see it in my checking account. That's cash flow. It's not profit. Scenario number 2, more than triple the profit. You just don't see it in your checking account. Where do you see it? If I'm making the claim that you're making $34,000, where is it going if it's not showing up in your checking account? Yeah, you're both right. Equity in the real estate. And it's showing up in your net worth. And if you're focused on net worth, thinking like a business owner, then you will be able to truly compare those two scenarios together correctly. Cash flow matters. You have to ensure that you can cash flow the real estate. But it's not the same thing as profit or gain in net worth. This is what really educated real estate investors understand about the utilization of debt. So tax strategy and debt strategy don't necessarily make you money in the sense of dollars showing up in your checking account every month. Shift in mentality, you start to understand the power that those two things have in terms of generating wealth. I know that is like super boring to most of you. It's also incredibly important as a business owner. You will limit yourself, eventually, you will limit yourself if you're not able to at least engage in that type of thinking. Now, what you end up doing, all of you are going to be in different places. So I'm not trying to prescribe when you inherit the $100,000 from your uncle, you should go and buy 4 real estate investments. I don't know. Maybe you should pay off your credit cards. I mean, like everybody's situation is going to be different, but you should understand how to think about taxes and how to think about debt. Business owners need to be able to do that, and you're business owners. Okay. I didn't do a good job of leaving time for questions. However, I'm not like in a rush. So I'm going to state our goals for next session. And then we're going to do like a loose end so that those of you that need to jump off at 11 can. But if anybody wants to stay on and ask questions, please do. So for next time, we're going to talk about your goals. So change your focus to building wealth, not income. If y'all aren't convinced of this by now, hopefully you will be by the end of session 4. Don't think about your primary goal as a business owner as income. Think about your primary business goal or your primary goal as a business owner as generating wealth. They're 2 different things. Wealth considers taxes. Wealth builds on itself passively. Wealth considers things like quality of life and generosity. Wealth takes a more holistic view of your resources. Income is simple. Wealth is complex. And so what I'm going to encourage you to do is you're working on your personal financial statement. I want you to think about what is my goal for my own net worth. Just want to acknowledge that some of you are like, I'm not sure I'm okay being the type of person that has a net worth goal and that could recite my net worth at any point in time. I'm just going to challenge you to say, whether you know what your net worth is or have a goal for your net worth, you all have a net worth. It's positive or it's negative. You all have a net worth. Not knowing what it is doesn't change the fact that you have one. And not thinking about what your goals are for it probably resigns you to an unintentional model of thinking about money. So I'm not saying your net worth goal needs to be $10 million. You might not be comfortable with that. But understanding that you have a net worth and that you need to orient yourself as a business owner to a net worth goal on a certain timeline is much more helpful than thinking about how much money do I want to make per year. They're related, but they're very different. Okay, so your assignment for next session is to have a personal financial statement. And I'm going to ask you, I'm not going to hound you for this, but you need to prove to me that you have one. Whatever information you want or don't want to be on it, no problem. If you want to print out the PDF, Rosie sent out that template. You can use that one. You can use, Google it. You'll find 100 different templates. Any of them are probably fine. Create it and prove to me that you created it. But while you're working on that, you're going to have questions. Everybody's circumstances and finances are different. So you're going to try to figure out, like, wait, how do I apply this to my personal financial statement? I am happy to help any of you think through that. We're going to have some time at the end of session 4 for Q&A, particularly on personal financial statements. So kind of jot down any questions you have, just do the best that you can in creating it or editing your current one to make sure it's current. And then we'll try to hit those as a group in our 4th session. Okay, it's 11, which means this is a guilt-free opportunity to hang up and leave the call. But I do have time to take questions. I know the taxes and debt conversation, it's like speaking your language for half of you and driving the other half of you crazy. So any questions from what I shared about taxes or debt?
One question I have for buy and hold rentals, is there a general kind of rule of thumb of